Welcome back to Your Personal Bank Show. We've been talking a lot about what your personal bank is and positive arbitrage. And again, if you didn't hear in the previous segments, I'm going to encourage you to go back to yourpersonalbank.com and listen. You can listen to any of the previous shows anytime you want, but check it out. But in a nutshell, really what your personal bank is it's combining two specific financial tools from the banking and the insurance industry to create positive arbitrage or earn income, earn interest on money that you used elsewhere, that you spent. You either spent them on bills, you purchase something, or you are investing that money in other assets. So I used the example with the last segment with the business consultant, showing where a business could increase their top line profit margin. In many cases, in his example, 20 to 30%. Because if you're adding another 2-3% positive top line profit and your profit is 10%, that's a 20-30% increase. That's very significant. That's huge. Okay. But let's use an individual. I had an individual example literally yesterday. They had refinanced their home, actually. They signed the documents, closing papers yesterday. And their interest rate, 30-year fixed, was 3.25%. Okay? And I showed them there, and they had some other accounts and some financial accounts that they weren't happy with. And they were a little frustrated about what's going on and some volatility and various other reasons that they just weren't satisfied. And I said, what if we reallocated those dollars, we funded them into the personal bank? And again, in their case, I was able to get them 6.1 crediting. They've been paying that 6 or higher for the last since 1996, okay, and before. The company has actually been paying dividends every year consistently since before the Civil War, okay, so long-term dividend interest crediting, okay? And I said, well, and then we're going to set up a bank line of credit using the cash in that policy as collateral, and the interest rate on the loan on the bank line is 3% currently. So therefore, what's happening is by flowing the dollars into the personal bank, then and earning 6, and then taking them out through the bank line of credit and getting charged 3, they're making a 3.1, and they're just 3.1% positive arbitrage. They're earning 3% on the money that they spent they're going to use to pay the mortgage payment. Now this is what makes it really interesting. As I said earlier, their interest rate on their mortgage was 3.25. They're earning 3.1 on their positive arbitrage on these dollars that we're using through the personal bank. So if you think about it a minute, what is their net effective interest rate on this mortgage now? 0.2%. It's almost free, okay? So you can really reduce the cost of loans and borrowing, like in their example, on long-term borrowing expenses, for example, like on mortgages. This can be applied to any kind of debt. What if you have a student loan? What if you have car payments? What if you have some credit card bills? In other words, the higher the interest charged, the greater the benefit that we can create and offset that and get that paid off. By the way, we also reallocated some of the dollars. They had some credit card debt, and we wiped that out. We're going to wipe that out next month and earn 3% on that money too. So I said, you can keep paying the credit card company double-digit interest if you'd like, okay, and pay this off eventually. Or we can reallocate these dollars, wipe it out, pay them off, and then still pick up 3% interest on it in a positive arbitrage. Again, using the policy and the bank line of credit strategically integrated. That's what your personal bank is about. And this is why I find in the vast majority of cases I'm able to make a difference and help people financially. Because again, what's the key? What's the bottom line? It's not how much I make, that's part of it, or how much return I get on my investments, that is again part of it. But the total picture is how much am I earning or gaining in combination with how much is going out and how much expenses and interest I'm paying and things like that. It's the combination of the inflow and the outflow that builds wealth and changes financial futures. And that's the thing that we look at. Now, of course, can we increase returns? Yes, we have. I mentioned in the last segment, we have index returns, index options where the returns are 1 to 14% currently. In other words, in any given year, depending on what the S&P 500 does, you're going to get 1 to 14% basically returns. Okay, and the principal's guaranteed. So on a bad year, you make 1%. In a good year, you can make up to 14. It's that simple, okay? And it's kind of funny. Do some years, does the S&P go up more than 14? Absolutely. But I've been doing this 22 years, and I've yet to get the phone call or contact where somebody was mad at me because the market happened to go up 20% that year, which does happen, and they only made 14 that year. So far, I haven't gotten that phone call. We'll put it that way. But I get a lot of contacts where people are excited about, hey, when markets are going the other way, and they understand they're not going to lose. So again, there's the trade-off, okay? There's no free lunch, folks. I think we all understand that, and I share that with people up front. Is this an option for you? Here's the strengths, here's the limitations, okay? Every financial tool has strengths and limitations, which gets me to my pet peeve. When I talk about insurance and using these tools, it's not uncommon that I hear people mention, they've read or heard or been told negative things. And you kind of got to get past that a little bit, because here's what I've come to realize. A lot of the source of the negative comments or information or media or whatever it may be really comes from a place of either lack of understanding or it's a competitor. Let's face it, they're a competitive product, right? And so as a competitor, most folks are not favorable to the competition. Those of you who are baseball fans will understand this. Most people who are baseball fans understand that, New York Yankees and the Boston Red Sox fans, not fond of each other. That's a nice way to put it, right? And so if you're going to get advice about how the personal bank tool or the insurance tool works with the bank line of credit and all that, and you're talking to somebody who doesn't really deal with that, they're more focused on managed funds or the markets or other areas, or even real estate or gold or whatever, precious metals, whatever their thing is, doesn't really matter, cryptocurrencies, all that. If their focus is over there, the analogy is really, it's kind of like asking what a Boston Red Sox fan feels about the New York Yankees chance this next year. You're probably not going to hear a whole lot of positive. You know what I'm trying to say? So what I'm getting at is, this is what I do. This is what I've been doing for years and years. I have hundreds and hundreds of clients that do this, actively do this. In fact, we've even set up a private Facebook page where I'm in contact with these folks almost on a daily basis, and there's communication with us on a regular basis. And it's fun. It's a paradigm shift in thinking, no question. Most people are not taught this or think this stuff. Heck, we're not taught this in school. I wasn't. I was fortunate to learn this from some very successful individuals and folk leaders in the industry, and like to think I've become one of those leaders today. But we're in regular communication, so I've got a pulse on this, on how it works for people and how it changes their lives. It really does. Because again, it's not just how much you earn or how much your investment accounts grow. It's also what's the outgo. So what's the inflow and what's the outgo? It's a combination of the two. We got to look at both. And I guess the last thing I would say on this is really, for those that are focused in the markets and such, and of course, that's a lot of the audience here on this radio station, and I'm not negative to that. I'm one of those, I'm not going to say this is bad or that product's bad. I already said to you why. It's if somebody says blanket statements, this product's bad or that product's bad, by the way, they're just sharing their personal bias, and it isn't. I don't think it's helpful. And I say this to my agents when I'm training all the time. It's not supposed to be about you and your personal bias. It's supposed to be about the client and their needs and their objectives. So let's share what's important for them. What are their goals? What are they trying to accomplish? And I guess the big thing that I think a lot of people who are market focused do understand is a term called diversification. And to diversify into something that's completely outside of Wall Street and the markets, in a lot of cases, just makes sense. It's wise. It's wise common sense, so it's worth looking at. Stay tuned. In the last segment, I'm going to cover a few more details on this. It's worth looking at.